My name is Puaschunder. I come from, originally from Europe, and I'm currently in the Inter-University Consortium of New York, and it's a pleasure and honor to be here again at the ICSB conference. And I heard just right now from someone that I'm listed as a finalist for the awards. Thank you so much, whoever nominated. Yeah, it's an honor. Okay, so today I will be talking about Nudgitize Me, a behavioral finance approach to minimize losses and to maximize profits from heuristics and biases. And it's an honor and pleasure to present here in Taiwan. This research is centered around behavioral finance. Since the 1970s, we saw in economics, psychology, and later then sociology entering. And especially in the beginning in psychology, in economic and sociology laboratory and field experiments, people found that human beings are deviating often from rational decision making. They are prone to bounded rationality. Their rationality is somewhat constrained under time pressure, under uncertainty. And from there on came the trend of nudging and winking citizens to make better choices. So far, already 2 Nobel Prizes have been awarded for this extension of neoclassical economics, one in 2001 for the entrance of psychology into rational decision-making behavior theory, and then the last Nobel Prize went to Richard Thaler for his nudge theory that stated that governments all over the world are currently starting to show people how to make better decisions and to nudge them into making better choices. Around the world, this behavioral insights trends, using nudges in order to help people making better choices, has started around the world. I will list a few countries, but Australia, Austria, Canada, Colombia, Germany, Italy, UK, US, the EU, the World Bank, and the IMF by now have these behavioral insight units to try to find how to make value out of heuristics and biases. I list here 4 of the most prevalent heuristics that have been found in very many laboratory experiments and that shape our decision making day by day. So one is overconfidence. We think that we are better, smarter, brighter than we actually are. Myopic decision making. We are living in the now, and the now is way more important than our future selves. That might be because there is something like an overall risk, and we cannot estimate what we will be doing in next week because there's too much uncertainty around us. We don't know exactly what we will be doing in a year from now. So we have a focus on the present. There's something like preference reversal. If I make currently today a decision what I will be doing in a month from now, I am prone to make more rational choices than when I'm in the actual decision. So for instance, if you give me the choice, what will I go to the gym, will I be eating healthy in a week from now, I say sure, I want to do this. But then when I'm in the actual decision, I'm rather choosing the dessert, not the apple, and I'm skipping the gym. And where we see this is, for instance, long-term contracts, gym memberships for a year. People sign up for it and they think they will be working out the entire year. But in the end, they only work out in the first 2 weeks, and then they skip this because of uncertainty, because of heuristics, and because of choice reversals. And then also discounting self-control problems. So we usually have problems really discounting the future value of our choices. We usually overestimate the present, and we underestimate the future, how much we will need money, how much time we will need to spend on children, things like this. So people end up signing up for contracts, and they end up saving too little for the future. And yeah, so the newest extension of this behavioral insights trend is an extension of trying to improve people's choices. And the really newest trend, in this newest trend, is to open it up for behavioral finance. How can we improve our decision making when it comes to financial assets and money, thanks to the insights that we gained from nudges? So diversification is the standard strategy in finance. Do we have an understanding what diversification is in a portfolio? What does it mean to diversify a portfolio? It's usually a risk management technique. So if I go on vacation, I pack the sunscreen and the umbrella to be prepared for both. And the same holds for financial assets. You would try to diversify your portfolio. You would try to have assets that would even each other out. If the one goes up, the other one goes down. So if there is a market trend that certain assets go down, then you would still have in your portfolio certain assets in order to improve your financial wealth. And how you can use this in the nudge theory is, in order to enhance diversification, you can use the joint decision-making advantage that was found in laboratory experiments. If people choose one by one, they are not so rational than if they put choices together. So where this holds, for instance, is in hiring decisions. If people have CCBs one by one, they are more prone to have biased decision making, that they favor, for instance, the first one or the very last one. This is the primacy recency effect. But if you put CVs next to each other, you're better in comparing people and you're less prone to make these biased decisions. So you could use this joint decision-making advantage by trying to put assets next to each other and then use a diversification strategy, so you would be not so biased. And by putting them next to each other, you could compare them better and then find a better diversification or diversified portfolio than if you just choose one by one and put them then all in one portfolio together. A second idea is to use crisis-robust techniques. So financial social responsibility and socially responsible investments is the entrance of social values and ethicality onto financial market decision making. And this is usually, so there I bring in the next slide a few examples, but this is usually the case when people have ethical concerns about certain market behavior and they rather choose certain portfolios because of an ethical imperative, or they would try to avoid certain portfolios because they think it's unethical what's being done there. And in the short term, it's usually a very costly decision making because you have to scan financial market assets for alternative viewpoints, for ethical considerations, which usually are not the case to be prevalent in your financial asset management. But you do get a first mover advantage. So often people have an ethical consideration about certain markets, and usually ethics come first and then laws and public policy follow. So if you have this hunch that there's something weird going on in the market and you move out as the first, you potentially can sell your assets at a higher price than before laws and regulations roll in. So one of the examples, for instance, is political divestiture. If you know there's something weird going on in the market, so then during humanitarian crises, or the classic example is South Africa during apartheid. If you were one of the first ones who felt this market is wrong, we should not invest in a market and fortify a system that's unethical, and you move out first, you have a better advantage than if you go then once laws and regulations come in and say you should not invest in there. So you could tap into this first mover advantage. And with financial social responsibility and socially responsible investment, there are heaps of studies that show they usually underperform markets to put ethics into market decisions on the short run. So usually you don't have so high of returns, but on the long run they show to be very stable market options. So during the 2008-9 world financial recession, we saw that financial social responsibility and socially responsible investments were not only more stable than the rest of all assets, but there was also like a drive towards financial social responsibility and socially responsible investment. So you do have a crisis robust, more stable option with socially responsible investments that you can tap into. What are financial social responsibility and socially responsible investments? Those are on the one hand screenings. So if you consider externalities in your financial decision making, for one, you would see if there's positive advantage of human rights, attention, equal opportunities, labor relations, or environmental concerns. These days, carbon divestiture is a very hot topic. People are moving out of carbon investments. And this is a case of the negative considerations or negative externalities. People think that there's something wrong in certain markets. And that is the case of political divestiture, and these days in carbon divestiture, where people would just simply exit certain market options due to ethical consideration. Shareholder advocacy is when shareholders meet and they exchange information about corporate social conduct and in proxy votes. Community investing is giving low-class communities access to finance, housing, employment, and minorities development. That's also a bit in terms of the Grameen Bank that got a Nobel Prize, I think, in 2008, the Peace Prize, which shows very high rates of paying back. So people do not have a default, and that's because it's usually a network strategy. Usually these funds were loaned by neighbors or very local communities, and people just feel ashamed if they know they are owing money to someone that they know. It's easier to default on a bank. It's very anonymous by now than if you're really in your community and someone gives you the money to start your own business rather than just selling products for low returns. And so here you have again the stability. And social venture capital funding, that's usually startups and social entrepreneurs. From the history, we can say that these ethical investments come from religious and moral considerations, but also socio-political deficiencies, corporate misconduct. So it's usually in the bomb cradle of the crisis, financial social responsibility blooms. Historical incidents, we saw Vietnam War, apartheid, minority empowerment, but also legislative compulsion, and that goes back to the point, you could be the first mover if you have an ethical hunch that later on becomes a law in disclosure acts, social justice considerations, or consumer rights protection, and stakeholder pressure in terms of shareholder activism and civil rights campaigns, and environmental catastrophes. Social responsible investment, just two of the major markets are the US and Europe. In the US you have the broadest variety of socially responsible investment funds. In Europe you have less outspoken socially responsible investment, but what you often have is that it's just practiced in a social partnership or in social cohorts, in community meetings when a corporate financial board meets with different stakeholders. So whereas you have in the US a lot of external and very explicit promoted socially responsible investment options, in Europe you have to be seeing more the broad stakeholder view and then go for options that embrace all the stakeholders. Who are the stakeholders? Public and private economic agents, organizational stakeholders we do have, so those are labor union representatives, banking executives and fiduciaries, and societal actors, the UN, NGOs, but also like small and medium-sized enterprises, but also media representatives and academics. In the future, there is definitely a trend also going into Asia. Socially responsible investment has become an issue, and socially responsible investment has become a risk prevention strategy in order to minimize emergent risks and also to regain trust, especially when crises hit markets. Other strategies how to use your nudges and heuristics in order to improve your financial outlook would be the next strategy is to think about demographics. So you can see certain trends are currently emerging in society. There is an immigration wave in Europe, so you can make predictions that certain banking institutions and certain banking traditions will shift towards communities that are currently entering the Western world population. And usually immigrants, the second or the first generation of immigrants is very productive and very entrepreneurial. So you can make a prediction that in about 20-30 years these market segments will hold on to financial assets. The age composition, Western world population, the Western world population is aging, so we can make predictions that the baby boomers that will be retiring soon will have large assets and will be spending money on certain industries. You can say that that certain healthcare products for elder people, but also leisure activities for elder people, vacation, will be sectors that will be gaining. And what I'm currently also working on is technology trends. You do have the fintech, you have algorithms taking over, and there might be value and humanness in the artificial age. So as we see more and more robotics entering, I just saw the other day at Oxford University, the first surgery was done completely by a robot by now. So as we see that professions like legal professions or surgeons, medical services will be offered by robots that can work 24/7. We will see that there might be a trend in humanness, things that can be replaced by robots. So for instance, procreation, or for instance, creativity, humor, artistic excellence. This will not be so easily replicable. And or design, fashion designers. There are attempts to have algorithms figuring these things out, but so far these core human values are currently underpriced, and in the age when robotics will take over, they will become potentially more beneficial. Tangibility. We can say that credit cards usually boost your expenditures, hard currency, fiat money, cash in your hand. People are more conscientious when they have the actual coins in the hand and pass them over. So if you have a problem with spending too much money, potentially limit your credit cards. And what has shown to be very efficient is if you share information about your credit card expenditures with someone that you trust, that just if you have a shared calendar and someone sees what you paid with your credit card, then that usually also drives down how much you consume with your credit card. And have safe havens. They say when you go to a casino, when you gamble, you should always, when you win something, split it by half and only continue gambling with the other half. And do this the same when you go for financial markets. Whenever you gain something, split it in half and invest the other half, or continue potentially with the half that you won, but reinvest into stable market options like long-term secured savings, or buying a house with it, or gold, and continue only the gambling with half of it. And then almost finishing up, market communication plays a role. There can be too much or too little information. So in the pre-Brexit vote, there was very much movement in markets. A lot of markets saw this uncertainty, and they saw around that uncertainty sword that's hanging above you. There is too much information and too much transaction. There's also overconfidence in novices. So if you have a financial market advisor, if that person is young, that person is more prone to have herd behavior biases and be overconfident than if you have an elder advisor. And there can also be too little information. So after the post-Brexit vote, the market was very down and no one was really exchanging. And currently it's still a problem in the UK market that certain markets are just not so flexible and fluent these days. So at the Bank of England, the major problem is these days that the housing market in London is just very calm and no one sells or buys. And then the last point that I want to make, there is overconfidence in leaders that tagged markets. So you do have a problem with certain financial market executives and leaders that give too much information and they create booms and busts. So for instance, if George Soros starts selling or buying certain or start selling and buying in a certain market, you can have the predictions that there is herd behavior that other investors are following his tag, and he has also this theory of booms and busts that are created by market leaders. Yeah, stock market price expectations are very much centered around word of mouth, your social information sharing. It was found that your social cycles are really determining where you invest, where your children go to school, what church you attend, what social clubs you're in, influences your market decision. And going back to the old point that you need diversification strategies, you have to also think about other beyond the scope of your social circles in order to have a really diversified range of products. And the very, very last piece that I leave you with, also be considerate about the information sources that you choose. So for instance, there was a media bias found that the New York Times is chosen over Science and Nature. So often there is a breakthrough finding, someone finds a cure or a vaccine against something, and it's blasted in Science and Nature, and the market does not respond. And once this news hits the New York Times, all of a sudden the stock market goes up for this company. So if you're just foresighted, you could go through Science and Nature, figure out what research group is working on what patent, what corporation is behind it, and usually serious researchers have to lay open by whom they were funded. So you can figure out what corporation is having this breakthrough patent. And once you figure that out and you invest in that stock and just wait until it hits the New York Times, then you can be very sure that the stock market will respond to it. So there's an availability bias. People are overestimating the things that they keep on seeing. The highest rate of car accidents was after September 11, when people overestimated how dangerous it is to fly on an aircraft. So they started driving long distances, and you see really in the statistics a spike in car accidents. So be aware of what you see in the media over and over biases your decision choices, and rather go for potential media sources that are not so repetitive. So if Science and Nature blasts something, then potentially trust this more than if you see on CNN a stock option being promoted over and over again. Yes, and also political influences. There's a beautiful paper that shows what moves the stock market price at the New York Times. So you can see in the history of the US, when a Republican president was voted in, markets went up. When presidents were assassinated, markets went down. When the US entered a war, you can say that in general the market went down as well. And there is an information time bias. At the beginning and the end of the trading day, there's more movement, and at the beginning and the end of weeks and years, there's more movement on markets. And weekends and holiday breaks, usually there's not so much action going on in the stock market, which is also counterintuitive to the rational decision-making theory, where this should not play a role. So you can say that there might be better market options in those gaps where there's not so much trading going on. You might get a better deal or a higher sale easier in these gaps when holiday or weekend breaks are working. And with that, I leave it either up to questions or do you want